Okay, so we're going to look at a problem where we analyze some transactions and see how the assets, liabilities, and equity accounts are affected. We've set up this problem by setting up the accounting equation, which is assets is equal to liabilities plus equity. And in the first transaction, we're just establishing our opening balances. So we have assets of $100,000, liabilities of $50,000, and equity of $50,000. In the second transaction, we're going to buy supplies on account for $5,000. So we're gaining supplies, which is an asset. Assets going to increase by $5,000. We've increased a liability because we're purchasing on account. We owe someone $5,000. So liabilities are going to increase by $5,000. And there's going to be no change in equity. So we can check to make sure that our accounting equation still holds true. We have equity of $50,000, liabilities of $55,000, and assets of $105,000. So we're in good shape. In transaction number 3, we're going to sell inventory that costs $10,000 for $20,000. So this one's a little bit more complicated because we're giving up assets, but we're also getting assets. We're giving up assets worth $10,000, that's our inventory. In exchange, we're getting $20,000 of cash. So our net increase in assets is going to be the difference, which is our $10,000. That's the profit that we made on the inventory. There's no liability involved here, so no change in liabilities. But we earned some income. Okay, how much income did we earn? Well, it's the difference between what the inventory cost us and what we sold it for. So we earned $10,000 in income. So now we have equity of $60,000, liabilities of $55,000, which equals our assets of $115,000. In transaction number 4, we're going to pay for supplies that we purchased in transaction number 2. So if you look back at transaction number 2, we bought them on account for $5,000, and now we're paying the cash. So we're losing some cash, so assets decreased by $5,000. We're also paying off a liability, so liabilities are going to decrease by $5,000, and there's going to be no change in equity. So now we have equity of $60,000, liabilities of $50,000, and assets of $110,000. In number 5, I've counted the supplies that I purchased in transaction number 2, and I've determined that they've all been used up. We don't have these supplies anymore because they were used by the office. So when we use up assets, we have to record an expense. And we're going to start out by decreasing our assets by $5,000. Right, we no longer have the supplies. And we're going to record an expense. So expenses are going to reduce equity. So we're going to have a minus $5,000 here. There's no change in liabilities. So we can check our accounting equation. We have $55,000 plus $50,000 is equal to our $105,000. In transaction number 6, we're going to pay salaries for $15,000 cash. So we're losing $15,000 in cash. All right, we're paying the salaries. There are no liability accounts involved. And once again, when we record an expense, this is going to reduce equity. So equity is going to fall by $15,000. And now we have equity of $40,000, liabilities of $50,000, and total assets of $90,000. In transaction number 7, we're going to buy inventory for $20,000 on credit. So inventory is an asset account, and we're gaining $20,000 worth of inventory. So we're going to add $20,000 here. We were also gaining a liability. We owe somebody money for that inventory. So liabilities go up by $20,000. And there's no change in equity. Okay. In transaction number 8, we're going to sell that inventory that we just purchased for $40,000 in cash. So just like in number 3, we have two effects on assets. We're going to lose assets worth $20,000. We're giving up that inventory, but we're gaining $40,000 in cash. So our net change in assets is going to be $20,000. And there are no liability accounts involved, so there's no change there. But we've earned net income of $20,000. That's the difference between what the inventory cost us and what we sold it for. So we're going to increase equity by $20,000. In transaction number 9, we pay last month's utility bill with $2,000. Okay, we just received the bill in the mail today, and we're going to write them a check. So we're going to have outgoing cash of $2,000. That's going to reduce our assets. We have no change in liabilities, and since we record an expense, that's going to reduce our equity. And finally, in transaction number 10, we're going to pay next month's rent, and we'll talk more about prepaid rent in chapter 3, but when we have a prepaid expense, we record an asset. So in this case, we're giving up an asset, which is $5,000 in cash, and we're gaining a prepaid expense worth $5,000. So we're giving up an asset and we're gaining an asset, and so these two transactions are just going to be a wash. There's no effect on assets. There's no effect on liabilities, and there's no effect on equity. So the key points I want you to learn from this exercise are, number 1, anytime you record revenue, that's going to increase equity, and anytime you record expenses, that's going to decrease equity. So remember that net income is equal to revenue minus expenses. So a positive net income is going to increase owner's equity, whereas a net loss is going to decrease owner's equity. And in fact, we can compare our ending equity balance to our beginning equity balance here, and we can tell that we must have had net income of $58,000 because that's how much our equity increased by. In fact, if you go through the problem, you record all of your revenues and expenses, you would end up with a net income of $8,000.